We've been taught to fear recessions like we fear natural disasters. A recession hits, the headlines scream crisis, markets tank, and politicians scramble to deny it's happening. But what if everything you've been told about recessions is wrong? What if recessions aren't economic disasters, but cures? What if recessions don't destroy economies, but actually save them? In fact, history shows recessions are the economy's immune system. Painful, yes, but essential. Without them, capitalism rots from the inside. Without them, bubbles inflate until they explode, taking down the economy with them. And without them, innovation dies. This video will show you a different side of recessions, the side no one ever talks about. By the end, you might even see a recession not as your enemy, but as your best friend.
Boom periods look exciting for everyone. The stock market keeps making new highs, venture capital sprays money at startups, and banks lend to anyone walking through their door. But underneath, the body is getting sicker. People make bad investments. Bad companies without profitable business models get rewarded, and bad incentives spread like bacteria in a petri dish. Everyone looks rich on paper, but the system is quietly rotting. Economists call this malinvestment. Capital flowing into projects that look profitable only because money is cheap, and not because they actually create value. It's why you get billion-dollar apps solving non-existent problems, office towers built with no tenants in mind, or luxury condos bought up by speculators while housing shortages keep rising. It's the equivalent of the body investing energy in cancer cells just because they multiply fast, but they serve no purpose, and eventually crowd out healthy tissue. A recession is the reset button. It's the immune system kicking in with the fever. Suddenly, capital is no longer free, and the companies that survive only by borrowing start crumbling. These are the so-called zombie companies. They don't produce enough profits to pay back their debt, but they keep stumbling forward only because credit is cheap. By 2020, over 12% of all firms in advanced economies were zombies, according to the OECD. In Japan, decades of avoiding recessions after its 1990s crash created an entire zombie economy, where failing companies were kept alive by endless bailouts. And we all know what happened there. 3 lost decades of stagnation and a future that has looked increasingly uncertain. Recessions kill zombies. And yes, it hurts, but that pain is how resources are freed for new, healthier growth. In biology, stress reveals the fittest traits. Economies are no different. Recessions test systems, models, behaviors, and ensure that only the robust survive.
It's like a forest that was never pruned. Dead branches pile up, undergrowth chokes the soil, and diseased trees spread infection. On the surface, the forest looks dense and thriving, but one spark can cause a wildfire that can burn down the entire forest. Recessions are the controlled burns. They clear the underbrush, remove the dead weight, and make room for sunlight to reach the new shoots.
Without them, the whole ecosystem suffocates.
Every boom builds a bubble. Tulips in the 1600s, railroads in the 1800s, dot-com stocks in the 1990s, housing in 2008. Crypto, meme stocks, and SPACs just a few years ago. On the way up, it feels like magic. Prices rise because prices are rising. Everyone becomes a genius investor, and people quit their jobs to trade. But here's the truth. Bubbles don't just inflate wealth. They misallocate resources on a massive scale. The tulip bubble diverted farmland away from food. The dot-com bubble poured billions into websites when companies with stronger fundamentals could have made better use of it. The housing bubble left millions of abandoned homes and broken communities. The cryptomania burned billions on digital tokens that could have been invested in productive industries. 2008 was proof of what happens when leaders try to avoid letting bubbles burst. Policymakers ignored the warning signs. Banks piled on leverage, and homeowners were convinced prices could never fall. When the housing bubble finally burst, it was a systemic meltdown that nearly destroyed the global financial system. Contrast that with the dot-com crash in 2000. That one was absolutely brutal as well. Trillions in market value were wiped out. The Nasdaq fell by almost 80%. Tens of thousands of tech workers lost their jobs. But because policymakers didn't try to artificially prop up every failing company or stop the recession from happening, the bubble was allowed to burst. It was painful, yes, but it was a controlled implosion that cleared space for genuine innovation. Out of the ashes came companies that actually created value: Google, Amazon, Intel, and Cisco, just to name a few. As Warren Buffett famously put it, only when the tide goes out do you discover who's been swimming naked. Recessions are that tide pulling back. They show us who was truly creating value and who was just floating on leverage and hype. When credit is cheap and markets rise with no end in sight, no one cares whether a company is actually creating value. What gets rewarded instead? Over-leverage, speculation, illusions of short-term success. And that's exactly when corruption thrives. By corruption, I don't just mean politicians taking kickbacks. I'm talking about the systemic rot that happens when fake competence is valued more than real productivity. I'm talking about CEOs manipulating numbers to hit quarterly targets, banks hiding risk in opaque financial instruments, regulators looking the other way because the economy is supposedly booming. In good times, the tide is high enough to cover the mess. But when recession hits, the tide goes out, and we finally see who's been swimming naked. Take Enron, for example. In the 1990s boom, it was hailed as America's most innovative company. But the only innovative thing about it was its accounting fraud. The company used mark-to-market accounting to book imaginary profits, created shell companies to hide losses, and paid executives obscene bonuses for deals that didn't exist. Wall Street analysts cheered it on because the stock kept climbing. Regulators barely blinked. It took the downturn in 2001 to reveal the rot. In the end, Enron, once valued at $60 billion, was worth nothing. Another example is Lehman Brothers. In 2006, its books looked pristine. The housing market was strong, profits were booming, and the bank's leverage of 30-1 seemed manageable because prices kept going up. But when the housing bubble burst, mortgage-backed securities were revealed as junk, and much of Lehman's assets became worthless overnight. Or more recently, FTX. In the crypto boom of 2020 to 2021, Sam Bankman-Fried was praised as a visionary. Celebrities endorsed him. Politicians lined up for donations. But the end of the crypto bull market showed us that FTX was just a Ponzi scheme built on vapor. The point is, recessions don't invent corruption. They reveal it. In boom times, investors don't ask questions because their portfolios are up. Politicians don't regulate because jobs look plentiful. Auditors don't dig deep because they don't want to lose clients. But when the economy contracts, lies stop working. Cash flow disappears. Balance sheets get tested. And suddenly, the geniuses are exposed as gamblers, conmen, or both. During expansions, people start to mistake luck for skill, speculation for strategy. Annual returns of 20% become the new normal. Homeowners convince themselves housing prices can only go up. Workers expect promotions every year, and companies assume their valuations will double just because the market exists. Every cycle, we hear that same phrase: "This time is different." We convince ourselves we've entered a new era where the old rules no longer apply, and history has no power over us. But recessions are the cold shower that snaps us back to reality. They remind us that risk is very real, and that growth is not infinite. This isn't just an economic reset, but also a psychological one, and one that's very needed every once in a while. When markets crash, illusions collapse with them. The friend who was suddenly a crypto millionaire disappears from social media. The startup that was supposedly changing the world goes bankrupt. Painful? Absolutely. But these shocks help build a more grounded sense of reality. And there's evidence that this reset creates long-term resilience. A study by Ulrike Malmendier and Stefan Nagel found that people who live through recessions invest more cautiously for the rest of their lives. They save more, borrow less, and are less likely to fall for speculative bubbles or Ponzi schemes. That's discipline that gets forged in crisis. And this also toughens businesses. Leaders who build companies during recessions, when money is scarce and consumers are cautious, develop habits that serve them long after the downturn. Compare that to leaders minted during bubbles, who mistake free capital for genius and collapse at the slightest sign of pressure. Recessions don't just reset markets, they reset minds. And in the long run, that's what keeps both capitalism and us sane.
When capital is cheap and money is flooding the system, inefficiency thrives. Venture capitalists are desperate to deploy funds, so they start throwing money at nonsense because anything is better than sitting in cash. Companies hire armies of middle managers, consultants, and culture leads, people earning $200,000 salaries to produce decks, sit in meetings, or design brand vibes. The problem is simple. In good times, nobody asks the hard questions. Investors look for growth, not profit. Companies want headcount, not efficiency. Workers want titles, not skills. And as long as markets go up, everyone pretends this theater is real. But it isn't. It's a jobs market built on illusion. For example, WeWork, at its peak, was valued at $47 billion. Not because it had a sustainable business, but because it rode the hype of tech disruption. In reality, it was a glorified real estate subleasing company burning billions in venture money. Thousands of people were employed in a fantasy, from community managers to yoga instructors for office tenants. When the hype faded, the company collapsed, taking all those made-up jobs with it. Or look at Theranos. Hundreds of employees built careers on a product that was basically fraud disguised as innovation. Many similar examples thrived because cheap capital rewarded the story, not the results. This is what recessions cure. Sure, they're painful, but what's left standing after are the companies and jobs that actually serve a purpose and create value. In the dot-com bubble, thousands of marketing jobs, e-business consultants, and web startups were vaporized. But out of the ashes came Google, Amazon, and PayPal, firms that survived because they provided real utility. An economy built on fake jobs and hollow growth is like a house of cards, beautiful while it stands, but destined to eventually collapse.
During the 2008 global financial crisis, the wealth of the world's billionaires dropped by nearly $2 trillion in a single year. In the 2022 correction, the combined wealth of the world's billionaires shrank by $2.6 trillion in just 12 months. For ordinary people who had been priced out of stocks or housing during the boom, this revaluation was a great entry point. When the rich lose on paper, downturns open doors for new players who couldn't afford to own assets previously because they were too expensive. After the Great Depression, some of the biggest fortunes of the 20th century were built by people who bought assets when nobody else would touch them. During the 2008 crash, private individuals and small investors who were willing to buy homes, land, or even stocks at fire sale prices multiplied their wealth in just 2 decades. The most important part about recessions is that they redistribute opportunity, a privilege which feels lost during bubbles. Housing prices fall. Stocks trade at discounts. Businesses once overpriced suddenly become affordable acquisitions. For people locked out during booms, recessions can be the rare moments when the system resets and an entry point appears. And on the personal level, recessions break routines and force reinvention. Mass layoffs sound catastrophic, and they sure are painful, but they also push people to reconsider paths they never would have explored otherwise. A 2019 study from the National Bureau of Economic Research, NBER, found that people who lose jobs in recessions are more likely to switch industries or even start businesses compared to those laid off in good times. In fact, some of the most successful startups, Airbnb, Uber, WhatsApp, were founded by people responding to job losses or limited opportunities in the aftermath of the 2008 recession. This is why elites fear recessions. Because they threaten hierarchies. They destroy paper wealth, topple corporate giants, hurt the major donors of political parties, and reprice the system in ways that allow outsiders to climb up. Booms are like a coat of fresh paint over a crumbling wall. On the surface, asset prices rise, jobs are plentiful, and tax revenues rising. Politicians congratulate themselves, central bankers boast stability, and voters assume the system is working. But underneath, the cracks keep spreading. Inequality widens. Debt levels break new highs. Supply chains get stretched too thin. Healthcare is underfunded, and housing unaffordable to most. During good times, these flaws can be ignored because the illusion of prosperity hides them. Recessions bring those flaws into the spotlight. When the economy contracts, the cracks become crises, and leaders are forced to act, often in ways they swore they never would. Take 2008. For years, banks were allowed to build a mountain of leverage. Households took on unsustainable amounts of mortgages, and regulators cheered the Great Moderation, a supposedly permanent era of low volatility. Then, the housing market collapsed, and the entire financial system was shaken to its core. Left with no choice, central banks launched quantitative easing, creating trillions of dollars to buy government bonds and mortgage-backed securities. The thing which was once unthinkable became a permanent policy. Or look at the global shutdown in 2020. For decades, companies optimized supply chains for cost, not resilience. Just-in-time delivery, offshoring, zero slack. It worked brilliant during booms, but the moment global trade froze, shelves went empty, factories shut down, and governments realized how fragile the system truly was. The result? Supply chains are now being reshored and diversified, with entire industries deemed too strategic to leave overseas. None of that reinvention would have happened without the shock of recession. In fact, recessions actually drive more structural change than elections. Campaigns are full of promises, but when times are good, leaders have no incentive to actually tackle hard problems. They actually act only when a collapse threatens their legitimacy. The irony is that many of the biggest policy shifts in modern history were born in recessions. The New Deal was born after the Great Depression. The creation of the welfare state in Europe happened after post-war downturns. The oil shocks of the 1970s created the neoliberal turn. The 2008 crisis gave birth to radical monetary policy. The 2020 crisis created the shift toward industrial policy and onshoring. Recessions don't guarantee better policies. They can also produce terrible ones. But they do strip away the illusion that the system is working fine and force governments to confront flaws they would otherwise ignore until it's too late. So, as unpopular as this opinion may be, recessions don't ruin capitalism. They save it. Without them, the system would collapse under its own weight. Zombie companies would multiply endlessly. Fraud and corruption would spread unchecked. Power would remain locked in the hands of incumbents forever. Recessions are the moments when the noise stops, the illusions fade, and the truth emerges. They are the stress tests that prove which companies, leaders, and institutions are real, and which were just marketing. Yes, they hurt. They always will. But maybe that's the point. Growth without correction is cancer. Progress without pruning is rot. An economy that never contracts eventually becomes a ticking time bomb. Recessions clear space for new growth. They force governments to confront the cracks they painted over. They reset our psychology and redistribute opportunity, opening doors for new participants and seeding the next wave of giants. This is why every recession, no matter how brutal, has been followed by renewal. The Great Depression gave us the New Deal and the post-war boom. The stagflation of the 1970s birthed Microsoft and Apple. The 2008 crash cleared the ground for a wave of startups like Uber and Airbnb. Even COVID's downturn reshaped supply chains, work, and healthcare in ways still unfolding. Recessions are not the end of the story. They are the beginning of the next chapter. So the next time you hear the word recession, don't just think collapse. Think cure. Think reset. Think opportunity. If history teaches us anything, is that every recession plants the seeds of the next boom. It's not just about industries. Recessions reshape culture. In good times, consumption becomes identity. You are what you buy, the car you drive, the gadgets you flaunt. But when layoffs hit and incomes fall, people relearn frugality. They rediscover skills, community, and meaning beyond consumption. That's why, historically, downturns often precede renaissances, because it's hard times that create hard people, and easy times that create weak people.